And for more, let's bring in now Andrew Patterson. He is Vanguard Senior International Economist. And Andrew Levin, of course, still with us. Andrew Patterson, I'm going to go with last names here. We've got a lot of Andrews on the panel today. First of all, let me just get, Andrew, your take on today's news. What did you make of the Fed's decision?
Sure. So it was very much as anticipated, right? No change in rates. So clearly they had to take that last hike off of the dot plot for this year. They did add a cut next year by pulling forward one from 2025. But in general, a couple of tweaks to market in terms of increase in GDP growth expectations this year, a lowering of CPI inflation based on that incoming data. But not a whole, or I'm sorry, rather PCE inflation, but not a whole lot of change for 2024, right? They still expect a slowdown in inflation. They still expect it to take until at least 2025 to reach that 2% threshold. So still some more work to do on their end. So that's what they're going to have to navigate as they head into 2024.
And Andrew Patterson, I'm gonna stick with you because I don't know if you heard what Andrew Levin was talking about just a few moments ago as well. You were talking about a little more work to do. It feels almost like some of the narrative out there has been, okay, we did it. Like soft landing, it worked, everything's fine. And Andrew Levin was sort of cautioning, I think, against that. What's your view on that sort of narrative that's out there in some quarters?
We would also push back a bit on that as well. And you're probably going to see Chair Powell do the same during the press conference today. We would expect in the second half of the year, macro conditions are going to weaken, possibly pretty substantially. Recession is certainly on the table, but a soft landing is a probability. Recession is our base case, but we are, discussing that. But heading into next year, it's going to be really about, just how long do they remain at the 5.5% at the upper range? How long do they remain at that threshold before they start cutting? We believe that's more of a discussion for the second half of the year than the first half.
And Andrew, when you say recession is your base case, can you quantify that for us? I mean, how moderate or severe are you looking for?
Yeah, that's really a key question. Just what do we mean by recession? Our forecast, whether it's for GDP growth, which we see as moderately posive, called somewhere around 50 basis points, or the unemployment rate, which we actually see it rising a bit higher maybe than consensus because we see the elevated level of the participation rate being maintained throughout the year. We think that the second half is really going to be pressing the NBER, and others to really acknowledge that conditions are recessionary, even though they're certainly not going to feel like, or hopefully not feel like, the 2008 or certainly the 2020 recession, but maybe something more akin to 2001, where you actually ended the year with somewhat positive growth.
Andrew Levin, I want to bring it back to you for a minute, sort of with a bigger picture question, if there can be a bigger picture than what we've been talking about. Have there been profound structural changes in the U.S. economy because of the pandemic, because of whatever? Or do you think that it is sort of, not to bring up the word transitory, but effects that mask that it's really just how it always is, that the Fed, the interest rate transmission mechanism works like it always does, and that a recession is going to happen like it typically does when you see increases like we've had? Well,
again, usually the recession would happen before the Fed starts easing. So it's definitely, there is a risk case here where inflation, super core inflation, other measures of service stay high, and the Fed doesn't ease much at all in the first half of next year. And that starts to slow the economy. The stock market, bond yields start going back up, and everything goes back to where it was a few weeks ago, right? And in that case, the risk of a recession in the second half of the year would certainly start to loom more than it does right now. It just depends a lot. Again, I think that's why we're all eager to hear what Fed Chair Powell has to say today. He's the sober kind of physician in the room trying to reassure the patient, but not to make the patient, stop taking the medicine. And so that we're not done here. These core measures of services inflation are high, and workers want to catch up with the cost of living, and those things are not over yet. So I would say absolutely that if anything, the effects of the pandemic are more longer lasting than we might have thought. That we're now 2 years since it seemed like the worst of it was over. But the economic effects are continuing and may continue now for quite a while to come.
And Andrew Patterson, I want to get you in as well, almost kind of responding to what Professor Levin is talking about there. Get your take on inflation, Andrew, where we are, and just how you see the trajectory of inflation playing out from here, the puts and takes.
Yeah, Professor Levin talking about, some of the concerns around supercore or services remaining high. Right, if you look at it, over 50% of the basket of services in CPI still remains above 4%. So that's certainly concerning. It's something that the Fed's going to be keeping an eye on, right? With whether you're talking about, inflation reports, whether you're talking about labor market reports, nuance is going to matter in those going forward as we try to navigate 2024 and anticipate when the Fed is going to start cutting and why, whether that's for a recession or because a soft landing is achieved. Right, underlying measures, not just looking at headline numbers like the unemployment rate, the actual inflation rate, but what's happening to services? Are those starting to come down as much as goods did? What's happening to long-term unemployed, or rather, what's happening to part-time for economic reasons? Are those numbers starting to creep up, which may belie, a more positive non-farm payroll headline number? So again, heading into 2024, as you try to navigate this last mile, if you will, of inflation back towards the Fed's target, nuance is certainly going to matter.
I should mention, by the way, we are seeing Treasury yields drop quite a bit here. The lowest level for the 2-year, I believe, since mid-June in reaction to what we've heard so far. Andrew Levin, why haven't we seen more of an effect on inflation from the rate cuts that have happened, the rate hikes that have happened so far?
You're talking about the core measures.
Yeah, I mean, even though you have the long and variable lags, et cetera, I think a lot of economists might have expected to see some more pressure there.
Well, the great thing is economists have lots of different points of view, so I'll just tell you my own, which is that the Fed was way, way behind the curve. And so a lot of what they were doing in raising policy rates was not tightening. They were actually just bringing things back to neutral. It's like the car is going down the hill and you have to start pressing on the brake to keep it from accelerating any further. It's going too fast, but you want to make sure it doesn't accelerate any further. So that's part of the answer to your question. Another part of it is that consumers' inflation expectations don't always match up neatly with professional forecasters or chief economists or with the Fed itself. And so you look at the Cleveland Fed has a beautiful survey of consumers done by Morning Consult every week. Okay, their latest number is 5.1%. Consumers expect inflation over the next 12 months to be 5.1%, not 2%, not 2.5%, not 3%, over 5%. And so when the Uber drivers or the auto workers or the barbershop or whoever it is are having conversations about payrolls, they're thinking of 5%. And that creates a challenge for the Fed to make sure that we really get all the way back down to 2.
Yeah, definitely. Well, we'll see what Jay Powell has to say about that challenge in just a few minutes. Andrew Levin, thanks so much for coming in and being in studio with us, and Andrew Patterson as well. Thanks to you both. Really appreciate it.